Hey, what's up everyone? Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about how to make a backdoor Roth IRA contribution. So if you make too much money and you're over the IRS income limits, then you probably know that you can't contribute directly to a Roth IRA. And you might be feeling a little bit left out. So in today's video, I'm going to give you 3 strategies where you might be able to get some money into a Roth IRA even if you're over the income limits. So let's start off, and what are we talking about here? Well, the IRS has some very strict guidelines on how much income you can earn and make a contribution directly to a Roth IRA. So for 2019, if you're single and you make over $120,000 a year, your ability to contribute to a Roth IRA starts to get phased out. And if you make over $135,000 for the year, then you can't contribute at all directly to a Roth IRA. For those of you that are married, filing a joint tax return, that phase out begins at $189,000, and if you make over $199,000, you can't contribute to a Roth IRA. Now we're talking about modified adjusted gross income, so I'm not going to get into all the details of what that is, but basically there is a few deductions that come off of that as far as your ability to contribute there. Now let's talk about how much money you can contribute to a Roth IRA. So for 2019, if you're under 50, they did just raise the limit on that, so you can contribute up to $6,000 a year to a Roth IRA. And if you're over 50 years or older, they give you a $1,000 catch-up provision as well, so you can contribute up to $7,000 a year. But again, that doesn't matter if you're over the limit. You can't contribute to that. So let's talk about some strategies for how you can get some money into your Roth IRA. Okay, so the first strategy that I'm going to talk about here is going to be to make a non-deductible contribution to a traditional IRA account and then immediately convert that traditional IRA account over to a Roth IRA. And this is probably the strategy that most people think of when they think of the backdoor strategy. And just to kind of refresh on that, so they have no income restrictions on you making a non-deductible contribution to a traditional IRA account, and they also eliminated the income restrictions on taking that traditional IRA and converting it over to a Roth. So as long as you have enough earned income to make the contribution, this is a strategy that might work well for you. What it's not going to work well for are any of you that have existing IRA accounts, and especially those existing IRA accounts where you have money that has not been taxed yet. Because when you make this conversion, the way the IRS does it is they use something called the pro rata rules, and they say that you can't just contribute, let's say $5,000 to one traditional IRA and then immediately convert that over to a Roth if you have other IRA accounts that are outstanding. So let's run through a quick example, and this might make a little bit more sense for you. So let's say you have $15,000 that's money in a traditional IRA account. It's money that hasn't been taxed yet. Maybe you got those tax deductions back when you were allowed to do that, or maybe it came from a 401k plan where you rolled some pre-tax 401k money over into a traditional IRA. And let's say you want to do this backdoor strategy with an additional $5,000, just to kind of make our math easy here. So when you contribute that $5,000 to your traditional IRA account, whether it goes into the exact same account as that other $15,000 or it goes into a brand new one, doesn't matter. The IRS is going to say now you have $20,000 in traditional IRA accounts, $15,000 of that is money that hasn't been taxed yet, and $5,000 of that is money that has been taxed. So when you do the $5,000 conversion, 75%, or basically, that $15,000 as a percentage of your total is going to be required to pay taxes on, and only 25% of that is going to be a tax-free Roth conversion. So it's not going to really accomplish what you want. So a couple ways around this. So number one is, depending on how much money you have in those traditional IRAs, if this is a strategy you think you want to do going forward, you might just say, hey, let's bite the bullet. Let's convert those traditional IRA accounts over to Roths, especially if it's not going to push you up into a higher tax bracket. And we talked about this a lot in our videos as well, of where in 2019, we've got this little bit of a reduction in tax rates because of the Trump tax cuts that went into effect in 2018. So it might be advantageous for you to pay some of that taxes now rather than paying those higher taxes in the future. So it might just make sense to maybe convert that and then basically start with a clean slate, and then you can do that backdoor Roth strategy going forward. If you have a spouse, maybe you have some money that's in traditional IRA accounts that's not been taxed yet, but maybe your spouse doesn't. So depending on how much you want to try to get into that, maybe you could do it in their IRA and then convert that every year. So that's another kind of way around that where you can take advantage of that backdoor strategy. And that's probably the most traditional backdoor strategy, but again, we've got two more here. The second strategy that I want to talk about has to do with a little known feature that might be available to you through your employer-sponsored retirement plan at work, like your 401k plan. So if your employer-sponsored plan allows you to make after-tax contributions to your plan through work, then you might be able to take those after-tax contributions and roll those directly over to a Roth IRA. And this is something that's relatively new because in 2014, the IRS provided some new tax guidance on allowing for exactly this strategy. So you might be wondering, after-tax contribution through work, do I have that? I don't know if I have that. Well, we're finding that more and more plans do offer this after-tax savings. So if you're not sure about it, if you're not 100% sure that it's not available, what I would do is I would hop on the phone, I would call your plan provider and just specifically ask them that question. Am I allowed to make an after-tax contribution to my 401k plan? And you might be surprised. They might have that option available. You're also going to want to ask them how much you can contribute to that. Some plans, even though the IRS might have some higher limitations, some plans might limit you, for example, to just 10% of your salary to that after-tax account. So you want to find out what those rules are. And then while you have them on the phone, the third thing you want to do is you want to make sure that they allow for something called an in-service withdrawal. So you want to find out, if I make a contribution to this after-tax account, will I be able to roll that over, let's say once a year, into a Roth IRA account? And you want to make sure that that answer is yes. Okay, so let's talk a little bit more about the mechanics of how this works. So after-tax savings accounts are really not anything new. They've been around at least for the last 20 plus years since I first started in the business. But up until relatively recently, in 2014, when they made that tax law change, really didn't pay a lot of attention to them because an after-tax account gave you no tax incentive for putting the money into the plan. And then you basically got tax deferral on any growth that was in there, but you ultimately had to pay taxes on the gains when you took that money out. So it was kind of like making a non-deductible IRA, traditional IRA contribution. There wasn't really a lot of benefit to that. So in 2014, like I said, they did make a tax ruling that now allows you to take that money and move it directly to a Roth IRA. So let's talk a little bit about some of the limitations. So you might know that your 401k plan has some limitations on how much money you can put in. So if you're under the age of 50, for 2019, they have limited those contributions to $19,000 per year. If you're 50 years old or older, they give you a $6,000 catch-up provision, so you can now contribute $25,000 a year to your traditional or your Roth 401k plan. Now your employer might match. Hopefully they do. If they match a little bit, that money is also going to get added to your 401k. So your contribution plus your company match, if you're under the age of 50, the IRS actually has a much higher limitation for how much money can go into that plan. And it's $56,000 for 2019 if you're under the age of 50, and if you're 50 years old or older, that's $62,000 a year. So let's just take a pretty simple example here. Let's say that you are 50 years old here, and let's say that you are maxing out your 401k plan at $25,000 a year. Let's say that your employer is also matching $7,000 a year, so you're doing $32,000 into your 401k plan between your contributions and your employer's matching contributions. Well, that limit is actually $62,000. So if your employer allows for it, the IRS says you can put another $30,000 a year into that after-tax bucket. And then let's say once a year, you can take that $30,000 and you can roll it directly over to a Roth IRA. And there's no income restriction. So it doesn't matter if you make $50,000 a year or $500,000 a year, anybody can do this. Now, again, remember, your plan might have some of its own individual restrictions. For example, some of the plans around here, they limit your contributions to that after-tax account to just 10%. So you want to make sure you understand that, and also make sure that they do allow for that in-service withdrawal. But this is like kind of a mega backdoor Roth conversion example here. So make sure you understand those rules and see if that's available for you. The third backdoor Roth IRA is actually another type of a Roth conversion. So let's say that you've already exhausted all of these other options. Maybe you've already done the first backdoor Roth strategy, put money into a traditional IRA, then immediately converted that over to a Roth. Let's say that you've maybe taken advantage of an after-tax account through work, or maybe you don't have that available to you, and you still want to get some more money into a Roth IRA. So I think, first of all, one of the big questions that we want to ask ourselves is, are we going to be in a higher tax bracket in the future than we are today? Or specifically, are we going to be in a higher tax bracket in retirement when we want to take that money out and start spending it? And I've talked about this pretty extensively in some of our other videos. I've talked about the 2018 Tax Cuts and Jobs Act and how most of us are probably going to be in a little bit lower tax bracket, at least until those tax rates expire at the end of 2025. And we talked about the government spending more money and some of the Social Security and Medicare issues, and the likelihood that taxes are maybe going to be higher in the future. So if you believe that, then one of the things that we should be looking at here are your three main tax buckets. And so if you think about it, most of us, or a lot of us, probably have the bulk of our retirement savings in those traditional accounts. And remember, those are the accounts that you're going to have to pay taxes on when you go to pull that money out in the future. Some of us are getting more money into Roth IRA accounts, and that's money we can take out in retirement completely tax-free as long as it's a qualified distribution. But some of us also might have money that's in what we call non-retirement accounts. So that's money that we basically have to pay taxes on every year through a 1099. We get interest income, maybe dividend income, capital gains, short-term, long-term. And so especially for those of us that might have money that's in that taxable bucket, that non-retirement bucket, can we potentially shift some of that money over into what we call a more tax-advantaged account? So let's say you have $7,000 and you said, hey, I really would like to put that money into a Roth IRA account, but I don't meet any of these other criteria. So if you think about it like this, and maybe you have some money that's in a traditional IRA account that is money that hasn't been taxed yet, you could look at using that $7,000 to effectively pay the tax on converting money from your traditional IRA account over to a Roth IRA. So let's say you're in a 25% combined state and federal tax bracket. To do the math on that very simply, if you had $7,000 available using that tax formula, you could actually convert $28,000 from that traditional IRA account over to a Roth. So now you're shifting that bucket a little bit. You're doing two things. Number one is you're getting more money into that tax-free bucket, so it gives us more tax options in retirement. And if we are going to effectively maybe be in a higher tax bracket in retirement, we're saving some tax money there, but we're also reducing our tax liability on an annual basis, because whatever that $7,000 would have earned, maybe through interest income or dividends or capital gains, by having that in a non-retirement account, now we've eliminated that. So we've kind of shifted the balance there a little bit, and that's something that we talk about pretty extensively through some of our financial planning. And we'll put some links down below, because we've got some other videos that really get into a lot more in depth. I think I do have a video specifically on the three different tax buckets. But so again, the third backdoor strategy is to use the money that you would have contributed to a Roth IRA to, in effect, do a Roth conversion, and that's a way to basically, provide that same type of shift. So anyway, I hope that's been helpful. Those are three different ideas. The first one is probably maybe one of the ones that you were familiar with maybe before you turned on the video, but hopefully we've given you a couple of other options there for you as well. So anyway, hope you enjoyed the video. Don't forget to hit that like or subscribe button, and we'll look forward to seeing you back in one of our next videos. Thanks. Have a great day.